Good evening, ladies and gentlemen, and welcome to another webinar with Axis Mutual Fund. Now, we at Axis Mutual Fund are always on the lookout for opportunities to come back, speak to you more often. And in a similar vein, we're here joined by Mr. Mahavir Kaswa. Before I get into the details with Mahavir, I think I must say it's been a great time at the markets for all. We've seen some volatility, we've seen up and downs, etc. We've seen a lot of geopolitical shocks. So we have an interesting strategy here today, which is going to help you cut through a lot of that. And to tell you about the strategy, we have Mahavir. So Mahavir has joined Axis Mutual Fund recently and comes with almost 2 decades of experience in capital markets and is extremely passionate about index funds as a category. So without further ado, Mahavir, let's start this conversation. And can you please enlighten us about this new feature that we have?
Right. I think it would be worth to talk about passive funds, how they have grown overall in India, and then maybe we can jump on to the value as a strategy particularly. Like I have been part of this industry for a while now, and what I have seen is that over the last 10 to 15 years, passive fund has grown long way. The first passive fund in India goes back to 1999, and after that it remained fairly small in terms of size. Eventually, Sensex and Nifty-based funds actually has grown, but the key catalyst for the growth of this passive fund as a category was CPSC ETF back in 2014, and then after that, government-led initiative where the EPFO started investing in Sensex and Nifty-based funds, and then few more such as Bharat 22, Bharat Bond. These are the very important funds, are the key milestones for passives to grow. As we speak today, the passive overall has category has grown to 11 lakh crores, and which is about 17% of the overall market share between the active and passive funds together. And today, as we speak, there are plenty of variety of options available. There are more than 450 passive funds that are live in the market across different asset classes: equity, debt, commodity, and international. And these passive funds are available in index funds and ETF format.
So before you get into more details, maybe let's take a minute to help the ladies and gentlemen here to understand a little more about these offerings. So if you could just take 30 seconds and explain what a passive mutual fund is,
Right.
and then probably let's get into factor-based strategies.
Of course, sure. So passive funds as a core aims to replicate the underlying benchmark. What I mean by that is there is no call by a fund manager taken in terms of stock selection or a stock allocation. What a passive fund manager should and supposed to do is he replicates the underlying constituents of benchmark. To take an example, for example, Axis Nifty 500 Index Fund, we replicate all the 500 stocks in the portfolio as well as like it is an underlying index, and we also aim to match or closely match the weight of our stocks in the Nifty 500 Index Fund. That's how the passive fund would look like for you.
And I think what we must also highlight is the key benefits of a passive fund or an index fund, which is
Absolutely.
it's free from fund manager bias, it's a relatively low cost investment option, and a customer can essentially fill it, shut it, forget it, right? You invest in an
Exactly.
index and you let it be. You open it on a rainy day and you'll be pleasantly surprised.
Absolutely. I mean, you don't need to really worry about where my fund is performing. Like, for example, there are a lot of time investors are worried about market going up, but the fund is probably not performing as much. In this particular passive fund, particularly, like you don't really worry because your fund is going to replicate the underlying benchmark performance as is, subject to some tracking error and tracking difference. That's probably. But apart from that, broadly, you can expect a performance of a passive fund to be in line with the benchmark. So you're correct.
Right. I think Mavi, I think so. Thanks for setting this context. Let's also try to get into what factor investing is. I know we've been chatting a lot, and the ladies and gentlemen here would have seen our website, our app. They would have seen multiple ads about it. But what is factor investing?
So factor is a technical or jargon concept, and it's fairly new in India. I think not more than an average history of more than 2 to 3 years, probably that is probably available as of now. However, globally, if we look back, it has been there for more than 20 years. What I mean by that is you are getting into factor-based investing, which is tried and tested globally. It's definitely new in India, but it's been there for more than, and there are a lot of assets riding on the factor-based funds globally. More than, if I just talk about US market particularly, there are more than 600 billions of dollars riding only on the factor-based funds. What is this factor fund in itself? Factor funds basically lies between active style of investing and passive style of investing. It takes a lot of inspiration from active fund manager, where the stock attributes plays an important role in stock selection, and so is for factor funds as well. In factor investing, you use a lot of financial ratios, stock price trend, stock riskiness as an underlying criteria to select the stocks in the index. And from a passive point of view, it puts that all this framework from active management into a very strictly rule-based and transparent framework. That's how the factor investing probably will look like, which is like a best of both worlds, active investing and passive investing.
Nice. And there, as we've discussed in multiple occasions, there are multiple kinds of strategies available within factors. So if you could just take 30 seconds to explain what these strategies are, and also get into our latest offering.
Sure. So globally, there are plenty of factors that are available or maybe recognized. However, if we look at the most popular, most recognized factors globally are momentum, low volatility, quality, and value. Of course, we will speak more in more detail about value, but if I could to quickly explain the quick philosophy of the each factor, starting with momentum. Momentum underlying philosophy is that stocks that are trending upward will continue to trend upward. That is the underlying hypothesis of a momentum. And for low vol is a strategy where the stocks that are least volatile are forming part of the portfolio. That is how the low vol port study would look like for the investors. And this strategy is very good for investors who are risk averse, who are looking to take risk lesser than the market in itself. Like this can be seen through standard deviation of the low vol strategy or drawdowns of a low vol strategy. Like a low vol is also a defensive strategy, and this index is formed based upon the different financial ratios such as return on equity, leverage ratio, cash accruals, earnings growth. There are different parameters that have been used to select the stocks in quality. And last but not the least is value, which we'll discuss in more detail. But the underlying premise of a value is forming a portfolio of a stocks that are less expensive in terms of their valuation multiples.
Actually sounds like a very good investment proposition. So I think without further ado, let's get into the nitty-gritties of this product. And
Sure.
probably let's get into the presentation, and over to you for your expertise.
Of course, thank you. And I welcome one more time to everyone. So let's start it. I'll just share my screen. I think as a topic today is about Axis Nifty 500 Value 50 Index Fund. We're getting to this NFO. The NFO is already live in the market, and this NFO will be closed on 18th October. So idea here is to discuss about the value as a strategy and how it has performed over a period as well. So
Mahavir, I think there is those bars still on your screen.
Yeah,
You have
I hope
to.
it is good now.
No, they're still there.
All right.
Yeah, it's better now. You can go ahead.
Sure. Yeah, almost. I hope it is better now. Yeah. So for us to understand value, I think value is a fairly familiar for us. We as an investor, we as a consumer, we are definitely a value oriented. And why I'm saying this is because, like, if any one of us is waiting to buy a mobile for the late night prices to drop, I think definitely we are definitely a value investor. Or on the contrary, if we are trying to book a flight ticket and if we try to juggle between different credit cards, we sometimes borrow our friends or family's credit card just to book get a discount on the flight ticket. I think we definitely can be related to a value investing. Or like a lot of time we go to a shopping mall during the monsoon sale or Diwali sale. That's also kind of a value as a strategy. And like a booking table at a fine dine restaurant through an app which has highest discounts available for us. That's probably something as a value style of investor. And when it comes to stocks investment, I think an investor who prefers stocks that are at a lesser valuation multiples is something in value investing probably. The core principle of value investing is buying stocks that are less expensive. And the assumption here is that stocks that are less expensive will outperform eventually the stocks that are more expensive. Value style of investing is one of the oldest style of investing, and the book called Security Analysis, written by Benjamin Graham, dates back to 1934. It's almost 100 years of content available for the value style of investing. And this style of investing has been further popularized by a lot of global investment gurus such as Warren Buffett and many such other investors as well. Um, yeah. So it is important to also understand how the value style of investing would work. Um, I mean, for any value investor, he would want to buy stocks or a portfolio of stocks that are less expensive or inexpensive or attractive in their valuation multiples is something important for an investor to understand that. And he would probably wait for a mispricing to correct and eventually sell the portfolio holding once the mispricing is corrected. That is how the value investor would rebalance his portfolio. As Benjamin Graham has said, we know from the experience that eventually the market catches up with the value in one way or another, particularly. Um, Now, as we spoke about stock selection, but it is also important to understand the different parameters that have been used in stock selection. Of course, broadly, this parameter stands correct. Some investors may have different perspective in terms of stock selection criteria. Now, in this case, particularly, the value investing in this particular case, value investing belongs to looking at the ratios such as price to earning. I think there's some issue with the screen sharing. Uh, can you confirm, Karthik or
Yes, it's still there, Mahavir. Maybe we'll have to reshare the screen once.
Is it good now?
There is still a bar on the right side of the screen, but otherwise it's good.
Yeah, I hope it is gone now. So we were talking about how to find the value stocks particularly. I think some of the important parameters that goes into selecting the stocks or forming the portfolio of stocks is through looking through the valuation multiples such as price to earning ratio, where we compare price of a stocks versus the earning per share. Similarly, price to book value ratio, where the book value per stock has been compared with the price, and price to sales ratio. These three ratios have been looked into the manner where the lower the better it is. And the final metric, which is dividend yield, is also an important metric in terms of identifying value stocks. In this particular case, we look for a higher the better, which means higher the dividend, the better, the more preferred the stock would be to be part of the value index. Now, as I speak about these parameters, it is also important to understand that any other layering of other parameters, such as some financial ratios, would bring this index away from the total level. So, when an investor is looking to invest into value strategy, it is important for him to understand whether they invest into true to level value strategy, which which just purely focus on the stock selection criteria, only on the value parameters, not any other parameters such as quality or maybe momentum as a stock selection criteria. There are plenty of such strategies available in the market, which also include other than the value as a parameter for stock selection. As we speak about value as a strategy, the most important parameter also for us to understand is when it performs. I think that is something all of us also would want to know until and unless probably it's not comfortable for us to invest into it. So value works best during the bull market and recovery market. It has slightly underperformed during the bear market, but the predominant market for the value investing is bull and bear. I do believe that even the bear market is good for the value because maybe it's a good opportunity for investors to start their SIPs or to make their lump sum investments as well. Value is a very good investment strategy for investors who's looking for long-term wealth creation. And we'll see eventually as the reasons why the value is very good for the wealth creation over a longer period of time. Now, coming to the most important part of this presentation is the fund itself, and the Axis Nifty 500 Value 50 Index Funds actually aims to replicate the returns of Nifty 500 Value 50 TRI. The NFO, as I already mentioned, is open till 18th October, and underlying benchmark we spoke about it. The fund manager for this is Karthik Kumar and Hitesh Das. This expenditure will be announced as soon as the NFO is over. The minimum investment amounts are kept fairly low for the investors to get into these strategies. Now, as we understand, the Value 50 index fund that we are speaking today is replicating the Nifty 500 Value 50. So it is important to understand the construct of the index. The construction start with the universe of a large cap, mid cap, and small cap that are forming part of Nifty 500 constituents. And you inserize the portfolio, the Nifty 500 composition for us, like a less liquid stock, or you remove stocks that are very small in the size. Thereby, you remaining stocks you have been screening for the value score. Now, how the value score is identified? You pull the data for each stock for a P, price to a book value, price to sales, and dividend yield. These are the four parameters that have been used to select the stocks. So for every stock, you pull the data, you combine the score to arrive at a final value score. Based upon the final value score, you select the stocks, top 50 stocks in the portfolio. The index is rebalanced semi-annually in June and December. For the diversification purpose, the weights of a stock is capped at stock weight is capped at 5% and sectoral weight is capped at 25%. Now, with this methodology, if we look at the latest portfolio that is available with us, what we look at it is that fairly large cap holding, and especially looking at the top 10 stocks, all the top 10 stocks belongs to large cap category, and the maximum weight is 5.9. The total top 10 stock weight is about 49%, provides us a fairly good diversification because of the maximum weight being capped at 5%. In terms of size class diversification, this index has a large participant from the large cap, followed by mid and small, about 19 and 13% each. In terms of sectoral allocations, the value generally tend to have stocks coming from the traditional sectors such as commodity, energy, financial services, and utilities. These are the predominant sectors we have seen to remain part of this index for a fairly good period of time. Another interesting feature of this index is this index brings in a lot of PSU stocks, and I have seen this historically as well. We have seen fair amount of participation by PSU stocks in the value as a strategy. For the latest portfolio, as we see, it is about 61, 62% of overall index weight goes to PSU stocks particularly. Now, the most important part probably is the performance. And as we see on the screen, the overall value 50 index has outperformed Nifty 500 with a substantial margin over a longer period of time. The since inception CAGR of a value has been about 17% versus Nifty 500 14.5%. Actually speaking, Nifty 500 return of 14.5% itself is a very impressive. Now, with the value outperforming by almost 3% itself, also can be a very interesting proposition for the investors. But one also has to remember that it also comes with a bit of a volatility as well. Now, recently, value has performed really well. About last 1 year return has been about 86.6% as compared to Nifty 50, 32.6%. But it also comes with a bit of a volatility as well. If we look at the second part of the chart here, a value has a bit of a higher share of volatility compared to the broader market particularly. And the classical way to mitigate the volatility part of the value is a lot of investors do use SIP route to invest in the value as well. It actually helps them to average out their buying prices over longer term and thereby creating good wealth creation over the longer period. As we see on the screen, the 10-year XIR for the value 50 has been fairly impressive, which is 25%. Investor who has invested about 12 lakh rupees over a 10-year period with a 10,000 as SIP amount for a monthly SIP, the overall worth of the entire investment is around 45 lakh rupees. That's definitely a good wealth creation for the investors over a longer period of time. Like again, point to point, and if we think about it, an investor who remained invested and had invested about a lakh rupees in September 2005, his investment would have been worth about 19 lakh rupees as of 19 years, 1 month lesser than 19 years, in fact. So in almost 19 years, the investment has grown to 19 times compared to Nifty 500, where the investment has grown to 12 times in the same period. Again, it is important to look at a different point in time, the performances, and in terms of calendar years also, as we see on the screen, Nifty 500 value 50 has outperformed Nifty 500 10 out of 19 periods. And especially when you look at that, outperformance are substantially large. Like, for example, during the expansion period of 2007 or the recovery period of 2009, for that matter, or during the 2014 also when the NDA government were formed. And also recently, value has been one of the best performing factor in India as well as globally. Another interesting aspect of value is 2010 decade of 2010s particularly, wherein it underperformed drastically to the broader market, and after that also it has outperformed on a point-to-point basis over longer term. Now, as we see on the screen over here, the decade of 2005 particularly, wherein it had outperformed broader market with some margin. After that, it had an underperformance of about 4% for the entire decade. And in this decade, which is a decade of 2020s, what we see the value has outperformed substantially. It has recovered substantially and has outperformed the broader based indices with a good margins. So like a very strong recovery after the last decade particularly. An interesting aspect here. So what we're looking at is we have seen that investors generally stay invested in a particular strategy for about 2 to 3 years. So hence what we did here is that we tried to calculate rolling numbers for a 3-year period and we plotted them on a chart. The top chart indicates the outperformance to Nifty 500 and the bottom chart indicates the underperformance on Nifty 500. And what we have seen is that the outperformance are generally higher than the underperformances. Of course, underperformance also is higher, but if we look at in more detail, what we understand is that our performance has been substantial and has been slightly more than 50% as a period. Like so, for more than 50% of the time, the outperformance has been there in the market on a 3-year rolling basis as well. I would easily probably get an outperformance about 6-7% on an average basis for the overall period, which is about 19-year period. I think we're coming to the almost final part of the presentation, but as intuitively, because the value portfolio is formed with the stocks that has a attractive valuation multiple, so we would naturally expect a value index also to have a valuation multiple that are much more attractive than the market in itself. And as we see on the screen over here, the valuation multiples of value index is around in the PE multiple particularly is about 13 times compared to the 27 times for the Nifty 500. The price to book multiple is about almost 2 as a multiple compared to the 4.5 for the Nifty 500. And dividend yield is expected to be higher. There are periods when dividend yield went up to the 10% or 8 to 9% as well. But recent rally has brought down the dividend yield close to 2 and 2.8% approximately compared to 1% for the broader market. So definitely valuation multiples for value index has remained very attractive for the entire history that we see on the screen right now. So just to sum up the entire learnings, I think a value is a very important offering for the investors and it is one of the oldest and widely used factor globally. The reason I'm saying it is important is because it has a less correlation with the broader market and hence it can be a very good diversifier for the investors. Value 50 index offers true to level value exposure to the investors. That is very important. Like I said, don't get confused with a lot of value funds in the market, which can be confusing for the investors. The index selects stocks from the large cap, mid cap, and small cap universe. And current portfolio of value 50 also comes from the some allocation to the large cap, mid cap, and small caps as well. Historically, value 50 has outperformed the Nifty 500 with a substantial margin, despite having a sharp underperformance for the entire decade of 2010s. And investor who is looking for exposure to PSU stocks also can consider value. As we have seen historically, value had a substantial allocation towards PSU stocks as well. I think I'll stop over here, Siddhant, and we can take some questions if there are any.
Mahavir, I think it was great, the explanation. I think you've explained it very patiently, and we have a lot of questions here. I think the folks on call have made the most of this opportunity. So let's take a couple to get started. So maybe, Mahavir, if you could, so this one gentleman asked us, what is the stock selection criteria used in the strategy? I know you just mentioned it, but briefly, if you could recap and probably go to a little more depth.
Right. So I think I'll first talk about the what make this index true to level in terms of stock selection criteria, and then we'll talk about why some other indices probably are not pure value index for the investors as well. To start with, the most important stock selection criteria for any value index has to be that relates to the price multiples. Most commonly used price multiples are price to earnings, which is PE ratio, price to book, which is also known as PB ratio. Price to sales is not very common, but very often used by a lot of market participants and who are like spending a lot of time in the market. And dividend yield. Now, dividend yield is also related to the price multiple because ultimately to calculate dividend for the last 12 months divided by the market cap is being used. Hence, it also has a relevance to the market. So, these are most important commonly used criteria globally as well as in India. Now, there are some value strategies or some value fund managers do use some extra screening such as quality parameters to identify stocks. Not saying they're wrong, but just saying that they may not be literally pure value as exposure. An investor who's looking to look for a value as exposure should definitely use pure true to level value as a fund. Like I have seen some funds using quality parameters such as earnings growth or maybe around return on equity as a criteria to screen the stocks, which actually tilt this index towards as a quality as a parameter, which can be slightly misleading.
I think that's great because I think nowadays there's a lot of buzz in the market about value, about factor investing, etc. So I think that's actually a very great evaluation of the
Right.
Indian investor base also, right?
Correct.
Because till a few years back, index funds were few and far between. But now, if you're getting into these intricacies, I think it's a great, and I think the future is going to be exceptionally bright for India,
Absolutely. Yeah.
right? So, yeah. So I think there's another question here, which says, uh, passive funds in India have grown over the last 10 years. Can you provide your perspective on growth of passive funds in India? I think we started with this,
Yeah.
so maybe a quick recap would help.
Of course. So the passive funds in India has definitely grown substantially. Like even if the last 5 years, if I look at that, the growth rate has been substantial, like about 45, 46% growth rate at a growth CAGR of 45, 46% is the growth rate for that. As we speak, the overall AUM of passive fund has grown to 11 lakh crores and market share is about 17%. If I look back 10 years back, the market share was barely 1.5% for the passive funds. So, and the most important part is the variety of the passive funds available. More than 450 passive funds are available in India for investors today, and with more than 150 unique strategies. Like when I say unique strategy, it means like Nifty 50, Nifty Next 50, Sensex, Nifty 500, Nifty 100, Value. These are different unique strategies that our investors can avail across different AMCs. And more than 150 strategies available in India over the last 10 years is definitely very good growth for the investors. And these funds also available across different asset classes like equity, debt, commodity, and international. So like Nasdaq, like there are a lot of funds available on the Nasdaq, like for fund of fund or in ETF or index funds also available on S&P 500. There's a lot of good investment opportunity investors can take the benefit of as well.
All right, thank you. Mohammed, there's another very interesting question. I think it quite resonates with me as well. Do you think this is a better solution to invest via an SIP or lump sum? In your experience, and also maybe if I would add a question of my own, what percentage of allocation would you make to this strategy?
Sorry, what was the second part of the question?
So what percentage of
Right.
your portfolio would you invest in this in a factor strategy?
Right. So I think someone who is worried about the volatility of the index should definitely consider as SIP to start with for sure. An investor who is having a minimum investment horizon of 5 to 7 years can also do lump sum investing. That's what we have seen. The market cycles generally have about a period of 5 to 7 years, and that is good enough for the investors to be into value as well. SIP can be always a fabulous route for a lot of investors who have a regular income can regularly park their investment into the value as a strategy. I do believe that value is an important part of your overall portfolio allocation. Why? Because if we look at overall India market and the tilt of the Indian market is generally towards the growth. Why? Because Indian market is growing and we definitely have a lot of businesses that are new businesses, new sector that are we getting into it. And we would always naturally have our portfolio tilted towards the growth or the quality as a aspect. And this results in having value into portfolio will bring in a lot of good, much needed diversification to the investors' portfolio. What I have seen is that the correlation with the quality of the growth stocks is very low, and that can be a good compensation for the investors who goes into quality as a natural tilt for them. Now it comes to allocations. I believe that overall 10 to 20% allocations looks very good from the portfolio point of view. But on a case-to-case basis, one can also look into 25 to 30%, but not more than that, probably as an allocation for the investors.
Okay. And it is interesting because I think nowadays, so in that case, Mahavir, maybe let's just double tap that. So you're saying maybe 10 and 20% for factors, or you recommend, or do you suggest 10 and 20% for index funds
So,
as overall?
I think I'm looking at the equity as a overall allocation, right? Like whatever, like let's say you have 100 rupees into equity. Out of that, naturally your portfolio will have a lot of tilt towards quality or the growth stocks. Out of which, if you have factors, great. Like, and there is a lot of things to be spoken about the factors. But just to avoid that confusion right now, I would say like 10 to 20% of overall equity can be a good allocation to the value as a strategy from a diversification point of view.
All right. Oh, interesting. Okay. So we have a question here. I think people are probably joining the link a little late, but I think we'll probably go through a quick recap. So Mavi, a gentleman asked us, what is factor investing and what are the factors we as a fund house are intending to cover? So maybe
Sure,
if you could, yeah.
sure, no problem. So factor investing is something lies between active style of investing and passive style of investing. Like a core objective of active investing is to outperform the benchmark, and that's what even factor investing does. And to do that, what the factor investing guys do is that they select the stocks based upon the stocks attribute, such as financial ratios like return on equity, leverage, or maybe cash earnings, or maybe earnings growth, maybe a price trend, or a riskiness of a stock, or a valuation multiple of a stock. These are different attributes that have been used to select the stocks in the factor portfolio. Now, coming to the passive part of it is very strictly rule-based and transparent framework. So every factor index has a defined methodology, defined rebalancing calendar, and it will stick to that. It will not try to change the methodology or rebalancing calendar just because of a different performance elements. So it takes best of both worlds, which is a low-cost nature of and transparent nature of a passive investing and stock selection and outperformance to the market. It's something taking from the active fund point of view. That is a factor investing in simple. Now, globally, there are plenty of factors available. However, the most commonly known factors are momentum, low volatility, quality, and value. Momentum is something wherein you form a portfolio of stocks that are trending upwards and you believe that those stocks will continue to well. In low volatility, the assumption is that I want to reduce my portfolio risk, and hence you build the portfolio with stock that has exhibited less risk available. Now, when I say risk, which means you look at the standard deviation or the volatility of the stocks. In quality, you want to form a portfolio of a stock that are higher in quality. To look at that, you use return on equity, leverage, and such very earnings growth and various such parameters. And value, I think we spoke in more detail. You use valuation multiples to select the stocks, such as price to earnings, price to book, dividend yield are some of the parameters that have been used in the value.
All right. Thank you. So I think a very interesting question. I think we warmed up the crowd quite well. So we have a question which says, what would have the value of 1 lakh rupees invested or a 10,000 rupees SIP in this index have been today?
I
I
think
think
this,
you did
yeah,
present this in your
yeah,
slide, so maybe, yeah.
yeah. This was there in the presentation as well. And it's a very natural question. A lot of investors like and understand this way also the growth perspective of the particular strategy. So I think from a lump sum point of view, if someone had invested in 2005, September 2005, the as of end of August 2024, his investment would have been grown 19 times. A lakh rupees invested would have been 19 lakh rupees as overall worth of the investment. Of course, this doesn't include the cost of fund management or tracking difference. Though there will be some impact, marginal impact that one can expect. But broadly, an expectation can be something similar to the investor. And SIP also, what we have seen is SIP fabulous performance by SIP as well. For the 10-year investment, assuming 10,000 rupees and SIP in value, would have resulted into investment of a 12 lakh rupees in total as an investment value over the 120 months. And that resulted into about 45 lakh rupees of overall worth of the investment. So definitely, again, there as well, investor would have got a lot of benefits of investing.
Wow, this, although we've seen these numbers a few times, every time you say it, I just think, why have I not invested in this?
Right.
I think I'll make an investment very soon. Anyway, so I think the last couple of questions, Mahavir, which is, I think we spoke about this very briefly. What sectors does this index focus on? So maybe if you could mention the top three, top five
Yeah.
sectors,
Yeah.
and maybe a brief outlook of those sectors,
Yeah.
along the India growth story.
Right. So the sectors that form in this index are generally traditional and the sectors that are such as like commodities, which includes metals or cement other companies, or maybe financial services companies, wherein you have a lot of financial services companies such as SBI or REC, for example. Apart from this, you have energy companies and utility companies. What we have seen historically as well is generally the sector attribution of this index remains fairly to this kind of sectors only. In terms of outlook, what I believe is that with the way India is growing, I do believe that these sectors have a lot of space to contribute to the India growth story. In terms of manufacturing, the way things are picking up and the need for these sectors to contribute into infrastructure, utilities is definitely enormous. And I believe that over a long term, investor can have a very good experience given this is long term.
All right. I think there's another very interesting question, I think very close to my heart, which is given the current market conditions, volatility, and potential geopolitical shocks, especially in West Asia, how do you think the strategy plays out in the near term?
Honestly, very difficult to comment about near-term performances, but one of the best way to mitigate such volatility, it is important to understand the overall long-term perspective of the market. I believe that no one can doubt about the overall growth trajectory of the India. I would rather use this volatility as a great investment opportunity. What happens is that a lot of time investors, out of fear due to the volatility, they stay away from the market, and only they get into market when the market started going up. And probably that's not a very wise decision. I would say stay invested in the market, invest regularly. That will create a very good long-term wealth for the investors. Value, as we have seen already through SIP, through lump sums also, staying long-term has always really helped to investors. It can create a good wealth for the investors. Consult your financial advisor. I think that can be a very good. He can help you a lot in terms of communication, in terms of helping understand complexity of the particular investment strategy. But the point being, staying long term is something important than being worried about the short term volatility.
Thank you. And I think that very resonates close to our house views, which is every investment should be held for the long term, especially SIPs. It's important to hold SIPs for as long as possible and to continue SIPs even during downturns,
Right.
because that's when the power of compounding helps you generate a corpus. Yeah. So I think Mahavir, thank you. I think we've come to the end. So ladies and gentlemen, the questions we've not been able to answer, please feel free to reach us on our website or on our mobile app or on any of our touch points, and we'll be more than happy to answer as many queries, as many questions as you have. So Mahavir, with that, maybe you could help us quickly summarize and just tell the ladies and gentlemen the top three reasons to invest in this fund, and we can go from there.
Absolutely. I think it is important to summarize the value as a overall. I think it is important to have a part of your portfolio merely from a diversification point of view. Value is one of the oldest and the widely used factor. It is also important to use true to level value strategy into your fund. Don't just go for any simple value fund that probably just have a level as a value. The unique feature of this strategy is that this fund, this underlying index actually selects stocks from the universe of large cap, mid cap, and small cap. So you can expect some good flavor of a large, mid, and small, particularly coming into this investments. And over longer term, what we have seen is that value has outperformed the broader market with good margins. Investors who are looking for long-term wealth creation can definitely use value as a good investment opportunity for their wealth creation journey. I think, yeah, that's how I'll summarize.
All right. Thank you, Mahavir. Thanks for this session. Thank you for your time.
Thanks, Siddhant. Thank you, everyone.
Thank you, ladies and gentlemen, for joining us for this session. We'll be back soon with another session very soon. Thank you and stay safe.
Stay safe. Bye.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.